Hello all, and welcome to this panel discussion sponsored by Mines and Money. My name is Mike Pickersgill, and I'm a partner at Torys LLP law firm and the co-head of our mining practice at Torys. I have the pleasure of moderating today's discussion in a fantastic panel that's been assembled by Mines and Money. Today's topic is a review of some of the key trends we've seen in the first 6 months of 2021 in M&A in the mining industry. The first part of 2021, we have seen largely a continuation of some of the trends and activity levels throughout 2020. M&A activity was steady in Q1, but didn't increase dramatically. It's remained relatively consistent, both in form and size. Q1 saw somewhere in the order of 375 M&A transactions, so continued strong volume, but a pretty wide range of sizes, representing about $13 billion of capital, a small uptick over the same period in 2020. So while the M&A activity hasn't significantly increased per se in 21, some of the key underlying industry trends that drove M&A activity throughout 2020 and continue now in 21 remain. Commodity prices are strong. We have stronger balance sheets for larger cap miners than have been the case for many years. And there are a number of strategic imperatives driving M&A activity and with the potential to continue to do so. We've seen a perceived, real or otherwise, need for exploration increase amongst all miners, reserve replacement concerns amongst precious metals miners in particular, a perceived need for consolidation, particularly in the precious metal sector, a growing focus on ESG priorities and impacting companies' determinations about capital allocation, and the increased strategic importance generally of battery and industrial metals. And all of these things, I think, are going to have an impact on M&A activity and are doing so in 21. So to help dissect some of these trends and activities in 21, Mines and Money has assembled a great panel. John Meyer, partner and head of research at SP Angel. John is a leading analyst in the mining sector. He's been ranked #1 among small cap metals and mining analysts in the UK 8 times in his career. He's known for his analysis of mining companies in a wide range of asset classes, precious, base, and specialty metals, as well as coal and iron ore. And he's helped guide many of these businesses to funding and achieving strategic goals. Jonathan Goodman is the President and Chief Executive Officer of Dundee Goodman. Jonathan has been an active participant in the mining industry for many years as a geologist, analyst, portfolio manager, and of course, the CEO of Dundee Precious Metals. And today brings to our discussion that variety of perspective. Most recently has been leading Dundee's continued focus on the mining sector, including mining investment, as well as a merchant banking function. And finally, last but not least, Rudolph de Bruin, founding partner, AMED Funds Corporation, which is focused on exploring, finding, acquiring, and developing mineral exploration and mining projects in Africa. Prior to AMED, Rudolph was a founding member of the Platinum Group, and fundamental to the acquisition of mining rights for Platinum and corporate development activities there. So welcome, gentlemen. And sort of to kick things right off, I thought it'd be worthwhile to maybe set the stage a little bit with a comment on industry fundamentals in 2021. We've seen commodity prices continue solid performance in 2020, in the first 6 months of 21. We've seen large cap miners and junior miners to a certain extent having the benefit of that support, and certainly amongst producers, strong balance sheets and available cash. So I'm interested a little bit on how we see that affecting M&A activity levels so far in 21 and a trend, if there's a trend there that will continue. And with these prices and these balance sheets and maybe the support, is this a good thing or is this actually a challenge for M&A activity? Maybe John Meyer, we'll start with you on this one.
Yeah, look, these are very interesting times. I think, we lived through the Asian crisis. Some of the guys here on the panel will have seen various other crises and cycles over their careers. We went through the global financial crisis. We went through the Chinese the super cycle driven by the growth of China. And now, of course, we're in, I don't know what this is going to be named in the future, but we've clearly going through a COVID crisis. And in some respects, that is changing the landscape. we had a quick look to see what sort of involvement there was from the majors or larger companies in the mining sector so far this year. We quickly put together 20 deals that we could see, and I'm sure there are many more, and particularly where the majors have changed their strategy. Well, we saw this actually start a few years ago, where we saw the majors building teams of experts to better assess and analyze the junior sector and the projects that were being brought to them. And we've been talking to these guys on and off over the years. Quite slow to get going, I would say, but they don't tell us everything that they're doing, and why should they? I mean, the fact is that majors used to like to buy oven-ready projects. Now, there will be exceptions to that rule through history, but if I think back through my career, I remember one of the first deals I started off with was Anglo-American buying into Reunion Mining for the Scorpion Zinc project in Namibia. I think one of the big seminal moments in the change of strategy was when Rio Tinto acquired Riversdale, and I don't need to embarrass Rio Tinto by going through the disaster that turned out to be on, I think, a number of levels. So that didn't work so well. So typically, as many large companies do, they put in a number of committees, they brought in more experts, they built new teams. And this isn't just Rio's, this I think applies to most of these larger companies, in order to improve their acquisition and investment strategy. And the great thing is with these companies that because of high iron ore prices and high other commodity prices, they've now got a lot more cash to deal with. Now, it's not that easy to persuade those companies to part with their cash. If anything, I think it's probably got more difficult over the years. Shareholders are very focused on getting that cash back and getting good dividends out of these companies, particularly in a world where dividends have become harder to get from many other sectors. In fact, the mining sector is, in many respects, has taken over from oil and gas and the energy sector in terms of its ability to pay big dividends. So there are a lot of competing forces for this money. But having said that, I think there is broad global agreement that the sector needs to invest more in exploration, because there simply isn't enough metal being discovered to replace the metal being dug out of the ground right now. And if we look at the big mines in Chile, big copper mines in Chile, and other leading mines around the world, these things are starting to run out. So we can see a finite life for many of the big producers, and in many cases, the companies that own them are becoming increasingly desperate to figure out how to replace those resources. So, for example, we saw BHP and Newcrest buying into SolGold for their pilot project in Ecuador. And I reckon they weren't that keen to get into Ecuador, to be honest. And in fact, in many respects, maybe SolGold provided a good platform for buying into a slightly risky jurisdiction like that, particularly a jurisdiction where environmental issues are often fought over. And we could go on for hours talking about this in more detail, but I think suffice it to say, we're seeing increasing situations where the majors are taking smaller stakes in explorers and then using that as a platform to help those guys build out what they're doing and use that to look forward to the next generation of exploration success.
I can
add to that for a minute. I think you have to also recognize that we are in a much different era from a company valuation perspective, both on the base metals and on the precious metals side. Is that, historically, more, gold stocks always traded at very, very high valuations. So it was always a no-brainer that an acquisition strategy was easier to be more accretive by buying something that traded a much lower valuation. But what's happened now is no one's trading at high valuations. I guess the average enterprise value to EBITDA valuation out there on the gold side is like somewhere around 5.5 to 6.5. And for the junior guys, it's not that far off. So it's much harder to get an accretive deal over the line, and we saw in last cycle a lot of deals people thought were accretive, but they weren't. Something had gone wrong, whether it was the technical due diligence or the misassessment of the community, or there were a lot of mistakes made. So I think shareholders are pushing harder that if you can't spend your cash wisely, at least give it back to us. And so I think there's good reason for that, but he's not wrong. I mean, we always have production declining. That's just the way we design our mines. We design our mines to maximize NPV, which means you're going to get the big production in the early years. So every year when you recast that reserve statement, they're going to redo that mine plan, and we're getting way more sophisticated using mega computers to put these reserve statements together. So you can bank on one thing, is that production 5 years out will always look a lot lower than production today, unless there's new projects coming on stream.
Maybe I'll throw it over to Rudolph.
Yeah, I can add a few thoughts here. I've been in this industry now for the last 30 years, and I've seen many of these waves come and go. And sometimes I feel like saying, I've seen this movie before. What I see are two big trends as far as pricing is concerned. The one trend is the majors and other companies are battling to find replacement assets for the mines that are running out. And in the old days, they used to do their own exploration, so they had good pipelines of projects. The trend for quite a few years now has been that they don't do their own exploration. They rely on the juniors to do the exploration, and then they just gobble up the juniors as and when these projects reach a certain stage. So on the one hand, the majors are squeezed. They've got to replenish their stock. And on the other side, I see the other trend, and that is obvious. Just this morning, someone did a calculation of how much cash is lying around in the mining industry at the moment. It's a huge figure. And the majors are returning cash to their shareholders, but the reality is they do sit on huge volumes of cash. So the last 6 months in particular, majors becoming a little more and more aggressive when they look for acquisitions, and they are prepared to pay more for it. So slowly, there is a race building up to acquire assets. And I think we might head into silly territory again, where there's a bit of a bonfire to try and get their hands on good assets. So although in the last few years they've been very prudent and done all the correct things as far as capital allocation is concerned and so on, I do see a slight measure of panic setting in where they are starting to scramble to get their hands on good assets.
I think
I can give a few examples. Sorry.
No, please go ahead, Rudolph.
Yeah, I can give a very recent example. We have a copper asset that we wanted to, we were looking for investors into the copper asset, and one of the majors were negotiating with us, but we also had offers from other companies. And we had a conversation with the major, and it went like this. The major said, okay, we'll invest, but you've got to explain to us how we are going to get control over the asset. We don't want to just invest. We want to get control of the asset. And you've got to explain the path to control to us. So we said, well, we've got an offer at a higher price at which you're offering the money. And if you want to make the investment, you had better make the offer, because we're about to accept the other offer. The next day, we had a written offer on the table for a vanilla straight investment at a premium to the money that we had on the table the previous day. As simple as that. So I can see a slow trend developing of more money chasing fewer and fewer assets?
Well, I think that's very interesting, because I think, over the past few years, we did see, with the focus on controlled, constrained allocation of capital, thinking about the lessons from the last M&A round, there has been a focus, and certainly there was a trend early on over the last couple of years to see deals being done as mergers of equals, no premium share exchange deals. And to your point, Rudolph, we have seen in the beginning of 2021 some M&A deals involving what I might have said were more traditional M&A premiums. And I'm thinking in particular of Newmont's acquisition of GT Gold, Fortuna's bid that's out now for Rox Gold, both of which include premiums. So I'm interested, building on Rudolph's point, and maybe I'll start with you, Jonathan, on this one. Is there a return to premium deals? Is what Rudolph's seeing something you see in the market as well? Do we see that happening in 21 so far, and maybe going forward?
I think I don't think it's ever been abandoned. I mean, the reality of it is certainly on, the mega deal, and that is where you really are taking in one company owns 52% and the other one owns 48 or 50-50. I don't disagree with kind of the merger of equals concept, because you really are taking two entities and creating one entity that's going to be bigger and better. But when Newmont takes over GT Gold executives aren't going to have a position in Newmont. It isn't a merger of equals. It is a real takeover. And to do a real takeover, you're going to have to offer something more than the market price, because presumably if shareholders wanted to exit at the market price, they'd have an offering at the market. So you're going to have to do something to entice shareholders. So I don't think the premium deal is dead. But certainly when it comes to the mega merger, I think they need to be much more strategic, and they need to really think. You think from the average institutional portfolio manager, who are the larger shareholders of all these things, they wake up one morning and find out one stock's up because it has a bid and another stock's down, and their portfolio is net neutral. So I think they get very frustrated with some of these things. But I think when it's one company clearly making an acquisition of a junior, you're not going to get it without a premium.
Now, presumably that creates some tension, particularly with supportive prices, and that issue about capital allocation and the pressure from shareholders, selling those deals. Mm-hmm. And John Meyer, you mentioned at the outset in your remarks about looking at some of those engagements between the senior miners and the juniors. Do you agree? With the requirement to pay that premium, where there's still strategic imperative, and how do you see that tension playing out?
Yeah, I mean, there has been an unusual amount of discipline with the majors in the last couple of years, and I think driven by some misallocated money in the past. But I think the West is having to compete increasingly with China for its resources. Governments are recognizing that governments and investors are recognizing that it's increasingly important for the strategic commodities to be available to the West. And I think what we're now seeing is big companies, like the big automotive companies, for example, looking to go further upstream, looking to work with mining companies to ensure that the supply chain is there for them. So I don't want to turn this into something where we're talking about battery metals, but I think this is going to apply to a very wide range of things. The US has just set up a strike force to look at a number of logistical issues and supply chain issues, one of which is the rare earths for the permanent magnets, to ensure that China doesn't have complete control, because what we've seen in recent years is China will increasingly use its control of these metals in these markets to get what it wants. And that needs to change. Over the last 10, 15 years, they've done this very softly, in that if you wanted to have security of supply, you needed to set up your manufacturing facilities inside China. Now that the West has decided that it wants to bring manufacturing back into the West, particularly back into the United States, and Joe Biden's or shall we say the Democrat approach to this is not really particularly different to Donald Trump's approach with the Republicans. Both parties recognize that industry needs to be reshored back into the United States. And that means having security of underlying raw material supply. So we're going to see, I think, more funds like TechNet, for example, accessing US government money and then putting that money to work in projects like Brazil Nickel, which was, I think, the first one they went into, and other projects like that to ensure that they remain in part of the Western supply chain.
Rudolph, do you, from an exploration perspective, from a mineral acquisition, acquisition perspective, do you see something similar? I mean, one of the, in addition, that US deal with TechNet was very interesting. Similarly, we see non-mining companies participating in the capital structure now. There's a lot of discussion, though I'm not sure a lot of transactions have been completed yet, but certainly a lot of discussion about auto manufacturers and others participating in offtake arrangements, looking for source of supply, the kind of strategic issue that John Meyer was mentioning. Is that something you're seeing? Is that something you're seeing impacting M&A in the industry in 21 and going forward?
Yeah, we've come across quite a few instances where we discuss a transaction and then somewhere in the background, is lurking the Americans, and with always sort of some undertone of them having the blessing or the assistance or support from the American government. That kind of thing is quite prevalent at the moment. We have a lot of stories floating around. How true it is, it's difficult to say, but I can definitely see a trend where I would almost, I think it's obvious we see the beginning of a trade war, a global trade war. The world is not as flat as they thought it was 10 or 15 years ago, when they started to take barriers away and free trade started to bloom. I think the Chinese were smarter when they negotiated the WTO rules, and they got the upper hand over the West. I've got a friend who's very high up in the WTO, and he explained the inner workings of the WTO to me. And what he basically said was that the mistake the Americans made was that they underestimated dealing with China Inc. They assumed that China would operate like the West, where you have an independent government making the rules and then independent companies working and competing within those rules. But China is working like one coherent block. I've visited China approximately 20 times over a 3-year period just before COVID, and you can see it. This is how these guys are operating. They do what is good for China. They don't necessarily do what is good for their individual companies. They've got a very coherent strategy to acquire and control resources. Now, I see the beginnings of a trade war where blocks are going to compete as blocks. The big blocks are obvious. China is one, America is one, the European Union is one. Russia seemed to be sort of acting like a block, and you can probably identify a few more blocks. Now, these guys are looking at security of supply for their block. And we see that they are starting to chase strategic minerals. They have lists of strategic minerals. So I think this is a new trend, that these regional superpowers are going to become players in inverted commas.
I want to shift just for one sec to maybe a related topic, which is ESG, Rudolph, and thinking a little bit to John and Jonathan as well on this one, maybe capital and asset allocation decisions and how that may be affecting M&A and how that is being driven, or at least there's a lot of talk, probably for healthy strategic reasons, about ESG, and thinking about that. as a driver for M&A activity. The obvious example being some of the divestiture of coal assets going on by some of the large miners. Maybe John Meyer, start with you. You see that continuing in 21 and forward?
Yeah, it's going to become an increasingly critical issue for a lot of the, well, it's already a major issue for the major companies, and it's going to become a bigger issue for the junior companies, starting with the mid-tier first. We've sat through meetings with the major fund managers where their ESG officers are invited into the meeting, usually at the end, and they will explain to the company in question what they're looking for. They effectively have a kind of scorecard. They have a series of things, generally starting off with corporate governance issues. But I see this as developing into the environmental and social side, because the funds that you're looking to get the money from are often they're getting money from LLPs around the world and other investors who are stipulating certain requirements for the ongoing investment. So we know that in adhering to ESG type issues is good for companies. Companies that are good at ESG are generally better companies to invest in. But of course, when we're talking about junior companies that are growing, it's often a bunch of geologists who've become successful, generally because they're good at it, and but they don't have necessarily all the skills for running a company and for all the experience on the ESG side of things. So it's good that the funds have officers who appear to be helpful at this stage, and there are various people in the market who are setting up businesses to advise companies on how to steer their way through the ESG minefield. Because what you don't want is, as a junior miner, to be ready to take money off one of the major mining funds, let's say BlackRock, JP Morgan, Invesco Perpetual, and then suddenly hit a roadblock at the end of the process where the ESG officer says, I'm sorry, you've got a director who's been on the board for too long, or you've got you're failing on some sort of environmental and social issues. You really don't want that. So you need to be there ready with all and proactive with the ESG scorecard effectively in place, so that you can demonstrate that you're doing all the right things from an ESG perspective. And I think companies that disregard that are going to lose out on raising the funds that they want from the capital markets.
Interesting question. You mentioned in a moment ago maybe a bit of a skills gap, between the expectation of the ESG funds and some of the junior miners in terms of addressing ESG issues. And maybe for Jonathan Goodman, is it possible this becomes a strategic driver that accelerates, the inflection point at which smaller cap miners is looking for a partner and or a sale process?
Well, I think it's already been happening. You got to recognize, ESG's a great buzzword that's thrown around a lot, but in a lot of other sectors. But in mining, it's kind of a necessity. The reality of it is, the environment, social, and governance, and certainly, if you don't get your environmental solutions right, you're not going to have a mine. If you don't deal with the local communities and deal with the social side of mining right, you're not going to have a mine. And this isn't something we're figuring out today. We knew this 20 years ago. So to some extent, certainly on the E and the S, the mining industry has been, working ahead of the curve because it's about survival. Like if a food and beverage company doesn't get ESG right, it's not, they've got time to work on it. But when you're a mining company, it's absolutely critical. So to some extent, I think you'll see, if you look at a lot of the more junior companies, they're embracing, the first thing you do is you really meet with that local community. You do a lot of work, understand who are the other affected groups, I think the days of having a junior company where it's just a couple of geologists and a case of beer are gone, and they've been gone for a long time. And to junior companies that aren't doing it, the answer is wake up. It's get going. It's an important part of this business, and the communities are going to judge you from the time you're taking your first soil sample. So how you behave matters all the time, and it's been that way for a long time. So I think to some extent the mining industry, and we learned it as an industry, we learned it the hard way. A lot of projects 15, 20, 25 years ago got killed because they didn't manage the social side of it right. The fortunate thing is we have really good environmental solutions for just about every problem. We have, as an industry, the ability of dealing with things and the ability to be able to show communities that a mine near your community should be a good thing. So,
one quick follow-up for you, and then get others' views as well. Consolidation, that's still a play, I mean, particularly amongst the precious metals miners in 21?
So I didn't hear who that was for.
Yeah, for you. So I'll start with
Okay.
you, just to follow up, and then we'll carry on. Yeah.
Consolidation is always going to be there to some extent, whether it's a new emerging company wanting to get bigger. And I think that the reality of it is, I think, at least from my perspective, bigger isn't always better. And so to me, I'm very focused on valuations and relative valuations, and all of that stuff. I apologize, my dog's barking, which usually means Jeff Bezos got a little richer, because in pandemic, our shopping is done through Amazon. But the answer is consolidation is always there. Every CEO is spending a lot of time saying, how do I make my company bigger and better? And sometimes they get the bigger part without getting the second part, but the second part's probably more important.
Mayor, any views? Any views?
Sorry, who was that for?
For John, Mayor.
Looks like I've got a bad line.
Oh, sorry. Yeah, look, I'm not the biggest fan of outright acquisition. Sometimes acquirers are going for acquisitions to hide some of their own issues and problems. But yes, as Jonathan says, it's a fact of life that there are always companies out there that are looking to grow to bulk themselves up, and some of this is investor driven as well, because investors often want to see growth. They want to see acquisitions in the market. They will pay bigger premiums for bigger companies, particularly in the gold sector, and that's just a faster way of getting larger, is to go through the acquisition process. Yeah, it's just I also think that there will be more acquisitions of private projects, I think, in the environment that we're looking at. Slightly less visible, but looks more like organic growth. But I think we'll see much more activity in that private space, and hopefully more of those companies coming into the market either through the acquisitive process or through IPO.
Yeah, I think as the world gets more and more complex and costs rise that you need to spend on non-mining issues or non-production issues like ESG, to make sure that you comply with all the requirements of ESG costs money. You've got to hire consultants in, or you've got to employ someone in your company. And there are many, many issues that are more and more expensive. Lawyers are more and more expensive. Auditors become more and more expensive. And you can't carry those costs unless you have a bigger organization. And that's just the nature of the game, is to carry those costs, you have to have a bigger base to spread it over. So I think consolidation is here to stay in some form or another.
But I also think you're going to have to, shareholders are going to be very wary of this, of consolidation, because you have to look back. And one of the things we recently noted, if you look at the gold industry, the GDX was founded, I think it was May 22nd, 2006, which means it now has a 15-year track record. In that 15 years, gold stocks have been flat, while the price of gold has gone from about, I think, $650 an ounce to $1,900 an ounce. And most investors who buy gold stocks, for the most part, are buying it for exposure to gold. And having a 15-year period where the price of gold has done what it's supposed to do and the securities haven't is a very, very unhealthy state. And I think when you also look beyond that and say, when gold price was $650, gold miners made a good margin. The cost of production. And we recently wrote an article talking about how gold mines make money, gold mining investors don't. And I think that's and that's why you're seeing the pressure from shareholders saying, pay me more dividends because you haven't done well with my money. So I think that we're going to be forcing these companies to really, you can't stop acquisitions because they need to do deals to survive, because every year you're taking a portion of your reserves and mining it. But I think what we're going to be really spending a lot of time forcing companies to really think these deals through carefully. And our argument has always been is you can do both. I mean, if you're one of the most successful mining companies in the gold sector is Agnico Eagle, and they've paid something like a dividend for close to the last 50 years, and not just a dividend, significant portion of their free cash flow, and they've still been able to grow their business. And so, our argument is it's time to start treating the shareholders as if they own the company. And if you pay out 20 or 25% of your free cash flow in dividends, you still have 75% to work with, and that can be a very healthy number. So,
we have a few minutes left, and I wanted to ask one topical question and then ask one wrap-up question and get each of your inputs on that. And maybe the topical question just is, I think John Meyer, you mentioned this right at the outset. We live in interesting times of COVID. How do you see the pandemic and living in the pandemic world in the first half of 21 as it continues affecting deal making? Is it an impediment to deal making, or are people finding creative solutions to work around diligence and social issues?
Weirdly enough, Mike, I think this is speeding the world up, because what we used to have pre-pandemic was lots of guys spending a lot of time flying around the world, getting to meet people face to face, working in the field, which was what a lot of the guys like to do. Now that they've been confined at their desks for a while, they haven't been twiddling their thumbs. They've been benchmarking themselves against their competitors. They've been looking at deals to do, because that's what you can do. You can achieve an awful lot on Zoom these days. Let's face it, most of the assets in the world are known one way or another. These assets don't move. It's not like somebody can pick it up and steal it very easily. So it's not that hard to do the due diligence. So I think we're going to see an acceleration. I've certainly had a lot of calls through the lockdowns from guys looking to do friendly deals with other people. And in one or two cases, we've had to go back and say, sorry, these guys don't want to deal. And then they started looking at potentially going hostile. And at some point, I think there's going to be a move for those deals to come through. And I don't think that's necessarily very far away. We're still seeing the majors are a little bit slow on their due diligence. If we look at Anglo American and Arc Minerals, for example, but that seems to be slowed up by corporate lawyers in South Africa, for example. So I think from a mining executive perspective, the M&A activity is very much in the front of their minds, and something that we could see a lot more of.
John, that was great, because you really consolidated my two questions. How's the pandemic affecting this? And then my follow-up question for everyone was going to be, how do you see the balance of 21 playing out? So maybe to you, Rudolph, next. The pandemic and deal making in the pandemic, and how do you see the rest of 21 playing out?
Yeah, this is a personalized view because my eldest brother is a virologist and a pathologist, so he's quite knowledgeable on the subject. What I learned from him is that the new normal is going to be that we just have to have annual vaccinations against the latest variant, and the world will pretty much return back to normal, except that you will just have to vaccinate regularly and do the sort of the basic things like sanitize or wash your hands and so on. So I expect the traveling to become possible again fairly generally within the next 3, 4, 5 months, and I'm working my schedule to make sure that I'm ready to do a little bit of traveling. As far as the commodities markets are concerned, we've touched on battery minerals today, lots of talk about gold and so on. But I want to just flag as a last thought for you for what I see a new trend developing. I've seen a few articles in the last few weeks, and that is food security. The world population has not slowed down with COVID, and I see a trend also in a race for fertilizer minerals. So watch the space. I think the next hot commodities are probably going to be the fertilizers, because there's a lot of pressure building up, and I can see in the next 18 months big movement up on fertilizer minerals.
Well, my friends in the Saskatchewan in the potash industry will love that for sure. And maybe Jonathan, we'll wrap with you with the last part of the question, which is the balance of 21. How do you see M&A activity in the mining industry?
I think I see more of the same. But I want to add one thing to the last comment is, I think the pandemic has changed the way we do business forever. And I think John alluded to it, but he didn't actually say it, is that, one of the things we did is, we pride ourselves on the amount of due diligence we do as a company. And in the old days, when we had a project we were really keen on, we might have sent 3 or 4 people to go to site right away. And what's very clear to me is that was probably premature. And the reality of it is we've spent a lot of time saying, what can you do from a distance? And, we all have been in this business for a long time and have enough contacts. So certainly you can find someone you've worked with that you have respect for over the course of your career that is in one of these countries that can go to site. There's a lot of stuff. Most of the data is digital. You can download it. You can work with it. You can look at the geological interpretations. You can do a very detailed reserve and resource audit. Most people who drill holes now use high resolution photography to photograph their cores. So you can actually have a good look at the core. So there's a huge amounts of due diligence that can be done virtually. And we're never going to change that, because every time you send someone to site, you're probably spending $10,000 to $15,000 with airfares, and you're sending serious professional people, and the long flights. They're going to have to fly business class. These are not inexpensive things. So there's so much you can do remotely, and then certainly at some point, someone still has to go to site, but things can be done a lot more efficiently and a lot better. And I do think that as this pandemic unwinds, and we've all learned all of these skills that can be done for less money and probably more effectively, we're not going to stop it. We're going to keep doing business this way, because you can do better work. And when you do get down to that site visit, you're not necessarily sending as many people, and you don't go on as many, because a lot of deals that don't happen can not happen cheaper. So I think it's going to be business as usual, regardless of the pandemic. And I've had a flu shot every year for many years, and now I'll get 2 shots every year for many years. It's not a big deal.
In fact, it may facilitate deal making, because it may be more efficient to make that first one in some respects.
I'm sorry, I couldn't hear you, Mike.
It may facilitate deal making because it may make it easier to take that first look.
Absolutely.
Well, listen, I wanted to thank, we've come to the end of our time, so I wanted to thank all of the panelists, John Meyer from SP Angel, Rudolph de Bruin from AMED Funds, and Jonathan Goodman from Dundee Corporation. As well, wanted to thank Minds and Money for the opportunity to put this panel together, and for the four of us to share some thoughts on M&A activity in 2021. Thanks all.
Thank you, Mike.
Thank you.
Thank you.